The Fed continued to play the waiting game at its June meeting. The minutes show that while they remain open to taking more action to boost the economy, things just weren't bad enough. But even if the economy gets worse, a third round of bond purchases, referred to as quantitative easing or QE3, could be past its time. First and foremost, some argue it won't do anything more than the first two rounds of quantitative easing.
The Fed's afraid of expanding the size of its balance sheet any further. And they're looking at the banks and realizing there are very few signs of stress within the banking industry. And since most of those funds would wind up just accumulating in the banking industry, they wouldn't be being passed on through to the rest of the economy, and therefore it really wouldn't do much of a macroeconomic impact. The original rounds of QE1 and QE2 were designed to increase the confidence level in the banking industry, and they've accomplished that.
Second, the economy might get better on its own given more time.
We think that the current risks to growth will fade, and in the meantime there are a number of positives. Looking at housing prices moving up, auto prices moving up, the housing market generally improving, and on, that should support growth later on. We have pretty soft growth in the current second quarter, but acceleration later in the year.
And third, the Fed's done enough in terms of monetary policy. Now it's time to focus on other options. But with Washington unlikely to make any moves ahead of the November elections, many are still hoping the Fed will take action. Bobby Rebell, Reuters.